Hello friends, hope you're doing well. Chris Lee, CPA here, back with another video for you. So today we are going to talk about using your S corporation properly when you're a service professional or you earn commissions or that sort of thing. So yeah, what you'll sometimes see is someone that's got an established business where they've been earning commissions, they have a customer base, and everyone, they've got an existing customer base, they've got, infrastructure that's all set up as a sole proprietorship. They've been, working successfully for years. They finally learn what an S corporation is, and they're like, okay, great. I would love to manage my self-employment taxes and use this entity structure to do it. But I've got all this other infrastructure in place that I don't want to dismantle. So sometimes what you will see is that people come up with workarounds, right? They want to maintain their infrastructure that's all under them, personally, and then but still get the benefits of the S corporation. So sometimes what you'll see is someone that's a sole proprietor. They're doing everything properly by recording everything, their profit and loss for tax purposes on their Schedule C, and that when they go to set up this S corporation and avoid these self-employment taxes from Schedule C, rather than actually change all the underlying infrastructure, the contracts, all those sorts of things, they'll just choose to do a management fee wash. So on their Schedule C, they'll report all the gross receipts that come to them on a 1099 that's under their personal Social Security number, and they will then take a management fee expense to, Jack Insurance Services Inc. or Scott Insurance Services Inc. or Brenda's, Insurance Services LLC, equal to the total commissions that were grossed on the Schedule C. So for this context, we'll use an insurance agent, okay? And they earn commissions off of selling insurance. So they have the gross receipts from their 1099s that were all issued to their personal Social Security number. They'll then maybe take a management fee for an equal amount and set it to 0. And then on the S corporation, they'll have gross receipts, management fee income from Jack, the expenses, some wages to Jack, and some overhead expenses, right? Those wages are reasonable compensation, which can be a different conversation about what is reasonable, but he's getting a spread, right? Some of the earnings are S-Corp profit that is not earned income, it's just ordinary income, which saves payroll taxes, and the other piece is the payroll taxes, which is an equivalent. It's wages that are subject to payroll taxes, which is an equivalent to self-employment. And so Jack is basically splitting the character of the income on his S corporation. And all he did was set up this entity and do kind of a shifting expense to that entity. And for this individual that's maybe doing this scheme, right? And it would be considered a scheme from IRS perspective. They are getting all the benefits of an S corporation, but not actually having all the paperwork properly aligned. So that's one way when people historically have had all this infrastructure, all this business. So like, hey, I want to, get the S corp benefit, but I don't want to change all of these other underlying facts and circumstances. This is what they'll do. And so that's something that people will think, oh, it's fine. Like it's pretty clear what I'm trying to do. But on audit, that's probably not going to be sustainable. We'll talk about that in a second. The second option is that, this person that maybe owns an insurance agent, rather than have their amounts paid to their personal account, they'll have it, paid to their S corporation's operating account. So in the end, though, the commissions are still paid out and reported on the individual's Social Security number on the 1099, and the cash never, even though the cash never touches the account, everything is kind of reported to the individual. So for this person, they're maybe gonna skip Schedule C entirely, reporting no gross receipts, no self-employment income, and the S corporation books all the ACH deposits that's revenue and pays, salaries and distributions out of the S corporation. So that is another strategy people will use. The problem is at that point, you're going to have a mismatch of receipts, of what's being reported on the Schedule C versus what's being on the 1099. So these are the two workarounds that someone that has this existing infrastructure that's wanting a S corporation benefit, they'll try to do without, blowing up the machine, right? Or reworking the machine in some material way. But when it comes to the IRS, they're gonna, really be asking the question of who earned the income. So and it gets down to this concept of assignment of income doctrine. This doctrine really comes into play, and it asks when the person who actually performs the services and controls the earning of the income is the one that it gets taxed to. So private agreements or internal agreements can't really shift that tax burden. It does not matter whether or not the money is deposited or what label is put on intercompany payments. If you're doing management fee, it doesn't matter which bank account it lands in. If this were to be reviewed or whatnot, it's really going to look at two key components. Who is the contracting party? So if you've got if someone's looking at regulatory rules or whatnot in the structure, they're going to ask who is the person or who is the entity earning this income. And this gets a lot to what is your public, right? Like, well, what are you advertising yourself publicly? Do you publicly advertise yourself as an Inc. or an LLC or that sort of thing that has property documentation to be an S corporation, on the back end? And then what does the contract say with your customers? Does your contract recognize the entity? Is that what's written on your contracts, or is it really someone else? And it's asking who is the service provider. So and basically you're looking at the legal tree for the individual relationship, and that is where everything is going to get taxed. So the S corporation cannot step in after the fact to claim what was already basically attributable to a natural person via some made up management fee or by routing ACH transactions to different bank accounts. So if this sort of arrangement is kind of in place and the IRS was like trying to dismantle it, the first method where we talked about the management fee, the first thing is that they're on the Schedule C, they go back, they look at the Schedule C, and they wipe out all that management fee deduction that they used to shift to the S corporation. And then on the S corporation, picking up the matching income, it's going to be dismantled. All those deductions may be able to be shifted back to the Schedule C, and everything's just going to be self-employment income. So basically, they'll reallocate the income, disallow or collapse the management fee that was created between the two tax filings, and adjust the S corporation accordingly. They're not going to probably undo the W-2 because you kind of end up at the same point, but there will be supplemental, there's going to be some supplemental self-employment tax that gets picked up. A lot of times when you've got Schedule C people that end up with W-2 wages that they shouldn't have, a lot of times it doesn't really go anywhere on audit because you're not really bypassing anything. You're really just you'll get that wage deduction, and then the residual of the income will be treated as self-employment and taxed. Is it correct? No. Is the IRS going to reverse all of it? No. It's way too much of a hassle. And it doesn't yield a result. It just kind of fixes some paperwork issues. Now, that's how they would dismantle someone that was trying to solve these problems with a management fee. And then on the ACH side, that variation doesn't really change on examination. An IRS agent's going to look at the contracts and the appointment letters, which are still, probably in an individual person's name. They're going to look at where are those 1099s actually issued, if they're issued under Jack's, Jack or Brenda or Scott's Social Security number. And once those facts are established, the IRS is going to treat the ACH deposit to the S Corp account as income first constructively received by the by the person earning the commission, and then transfer to the corporation. In substance, it basically recreates a management fee, but that management fee first has to get taxed at the individual level first. So it doesn't really change anything. You end up with the same consequence. They're going to just really dismantle the whole thing, they being the IRS. So when you want to use a management fee, the best way to do it, it really needs to be that the S corporation itself has real operations, staff, leases, systems that support the income producing activity, and that S-Corp management fee needs to be defensible for those services and probably not equal to 100% of the gross receipts from some related business. And the fee also needs to be documented and invoiced and consistent across years and clients, and not reverse engineered to be able to offset the 1099s that are coming to someone, in their personal name and social security number. So the fee is paying for genuine services and not just to move income around between people that are between entities and individuals that are functionally, the same. So really, when it comes down to S corporations, they don't magically absorb income just because the money flows to them. That's the most important thing to know. When commissions, arise, or there's some sort of, individual contributor that is producing the income, for tax purposes, it doesn't matter if you do management fees or you're going to do some ACH routing creatively. Really, at the end, it's going to come down to answering the question: where was the income earned, and under what contracts and licenses that actually govern the work? So if the answer to that question is an individual has produced this income, then the income stays with the individual, subject to all the self-employment tax. And that doesn't matter how creatively it is, moved through an S corporation. With a real S corporation, planning only works when the corporation is legitimately the income stream and recognized as such by contracts, regulators, and people paying the fees. So anything short of that is not planning. It's really just it's going to be easily unwound if there's an assignment of income problem that comes up, and it's usually an expensive consequence, because you'll have additional taxes, penalties, and interest on top of it. So all of this is to say is, if you are a person that's an individual contributor that's got all your clients and relationships and you're considering an S corporation, most important thing is actually update all of your contracts to be your S corporation entity. You're going to want to make sure that publicly it's, they're contracting with a business and not just you personally. Even if your name's in the business, in the title of the business name, it needs to kind of be separate and distinct, right? Like having that LLC behind your name or having the Inc. behind your name, in a lot of ways, and in most states, would probably suffice to say that, hey, this is a legitimate entity. You'd have to make sure that your entity is registered for the types of services that's being provided. So similarly, like if you're a financial advisor, right? Like really all the licenses for brokering trade transactions and all those sorts of things actually used to be in the entity name, not your individual name. For insurance, that would be the same way. The licenses need to be in the name of the entity and not in the name of an individual necessarily. So all of this to say, if you're trying to move into S-Corp realm, make sure that everything is consistent and aligns. So with that, I will leave a link down in the video description that'll allow you to connect if you want to have a phone call. And then otherwise, new video for you soon. Take care.